The petrodollar, once unshakable, is facing its biggest threat in decades. Western sanctions aren't just targeting nations, they're forcing a seismic shift in how the world pays for energy. Over the next 15 minutes, discover how new financial systems are rapidly emerging, revealing both critical weaknesses and unprecedented opportunities in this geopolitical rebalancing and what it means for your future. The petrodollar's shifting sands. For 50 years, the petrodollar has been the invisible foundation of American economic power. To understand what's happening now, you need to understand what came before. It started in 1974. The United States was reeling from the end of the gold standard, high inflation, and the aftermath of Vietnam. The dollar was vulnerable, so the Nixon administration struck a deal with Saudi Arabia that would reshape the global economy. The arrangement was elegant in its simplicity. Saudi Arabia would price its oil exclusively in US dollars. In return, the United States would provide military protection and sell advanced weapons to the kingdom. But the genius was in what happened next. Saudi Arabia would take those oil dollars and reinvest them in US Treasury bonds and Western banks. This created a perpetual cycle. The world needed oil. To buy oil, they needed dollars. To get dollars, they had to trade with America or hold dollar reserves. Those dollars flowed back into US debt, financing American spending at remarkably low interest rates. The system was self-reinforcing, and it made the dollar indispensable. By the early 2000s, the dollar accounted for over 70% of global currency reserves. Oil transactions were the engine of dollar dominance. 40% of all international trade was invoiced in dollars, even though America's share of global trade was just 10%. But something has been quietly unraveling. The catalyst wasn't an economic crisis. It was trust. Specifically, the weaponization of the financial system through sanctions. When Russia invaded Ukraine in 2022, Western nations froze Russian central bank reserves. Hundreds of billions of dollars held in Western financial institutions became inaccessible overnight. Russia was cut off from SWIFT, the global messaging system that enables international bank transfers. The message was clear: holding dollars and using Western financial infrastructure came with geopolitical strings attached. This wasn't the first time. The United States had been increasingly using sanctions as a foreign policy tool. Iran, Venezuela, North Korea. Each time the dollar and SWIFT became weapons, and each time targeted nations and their trading partners started looking for alternatives. But the early indicators of de-dollarization actually began years before Ukraine. China and Russia started conducting bilateral trade in yuan and rubles as early as 2010. In 2023, Brazil and China signed a yuan real trade settlement agreement. India began purchasing Russian oil in rupees. These weren't headlines, they were quiet moves. Bilateral arrangements between nations seeking to reduce their exposure to dollar volatility and sanctions risk. One agreement at a time, the foundation was being laid for a post-dollar world. Then, in June 2024, something symbolic happened. Reports emerged that Saudi Arabia had allowed its petrodollar agreement with the United States to lapse. The kingdom was now free to accept payment for oil in euros, yuan, yen, and rupees. The petrodollar system wasn't dead, but its exclusivity was over. The rise of alternative currencies. Today, the dollar still dominates, but its share of global reserves has dropped to 57.7% as of early 2025. That might not sound dramatic, but it's the lowest level in decades, and the pace of decline is accelerating. So what's replacing it? The Chinese yuan is the most obvious contender. China has been systematically promoting the yuan in trade settlements, particularly with countries facing US sanctions. As of March 2024, over half of China's cross-border payments were settled in yuan, surpassing the dollar for the first time. In Russia, the yuan now accounts for 42% of international transactions, up from just 4% in 2022. Even Saudi Arabia, the cornerstone of the petrodollar, is considering yuan-denominated oil contracts with China. This isn't about replacing the dollar entirely, it's about having options. India is using the rupee for energy trade with Russia. By 2024, India was selling the majority of its Russian oil purchases in rupees, bypassing dollar-denominated transactions entirely. The local currency swap agreement between China and Brazil now covers around 30% of their bilateral trade. And then there's gold. Central banks around the world are buying gold at the fastest pace since World War I. In 2023 and 2024 alone, central banks accumulated over 2,000 tons of gold. China, Russia, India, Turkey, and Poland are leading the charge. Gold's appeal is simple. It's neutral, unsanctionable, and inflation-resistant. As of 2025, gold now constitutes nearly 20% of global foreign reserves, up from 13% in 2017. But the most significant shift is happening through bilateral agreements. Nations are bypassing traditional financial channels entirely. China and Russia now conduct 90% of their trade in national currencies. France, a founding G7 nation and historically a US ally, finalized a liquefied natural gas trade deal with China in yuan, in early 2024. These arrangements allow countries to trade directly without converting through dollars, reducing transaction costs and eliminating exposure to dollar fluctuations and sanctions. And now, central bank digital currencies are entering the equation. CBDCs have disruptive potential in energy trade because they enable direct, programmable, sovereign transactions. China's digital yuan, the ECNY, is the most advanced. As of June 2024, total transaction volume reached 7 trillion yuan, nearly $1 trillion. China has integrated the digital yuan into over 24 bilateral trade corridors. The digital rupee in India has grown 334% in circulation from 2024 to 2025. These aren't just alternative payment methods, they're alternative financial architectures, and they're being built specifically to operate outside the dollar system. New financial architectures emerge. The most visible symbol of this shift is the race to build alternatives to SWIFT. SWIFT isn't a payment system, it's a messaging network that allows banks to communicate securely about transactions. But because it's headquartered in Belgium and subject to Western oversight, it became a sanctions tool. Being cut off from SWIFT effectively isolates a country from global finance, so nations are building their own networks. China has the cross-border interbank payment system known as CIPS. As of January 2025, CIPS has 1,467 indirect participants across 119 countries, linking 4,800 banks in 185 nations. It facilitates WAN-based transactions independently of SWIFT. Russia has the System for Transfer of Financial Messages, SPFS. It now has 159 foreign participants in 20 countries. Settlements with BRICS nations and national currencies have surged from 26% to 85% in just 2 years. India has the Structured Financial Messaging System. Brazil is integrating its own systems. And then there's BRICS Pay. At the 2024 BRICS Summit in Kazan, Russia, a prototype was showcased. BRICS Pay is designed as a decentralized, blockchain-based payment messaging system. It would allow member nations, Brazil, Russia, India, China, South Africa, and the newly expanded members including Iran, Egypt, Ethiopia, and the UAE to transact in local currencies. The system would use technology from India's unified payment interface and China's digital wallets. It would incorporate blockchain for transparency and security. And critically, it would operate entirely outside Western control. Russia has been the strongest proponent for obvious reasons, but Brazil's President Lula has also championed it, stating that the multipolar order they seek must be reflected in the international financial system. As of mid-2025, BRICS Pay remains in pilot stages, but the momentum is undeniable. At the 17th BRICS Summit in Rio de Janeiro in 2025, member states formally decided to move forward with creating an alternative to SWIFT. Blockchain and distributed ledger technology are central to these new systems. They promise secure, direct transactions without intermediaries. Project mBridge, a cross-border CBDC platform developed by the central banks of China, Thailand, the UAE, Hong Kong, and Saudi Arabia, reached its minimum viable product stage in June 2024. In October 2024, the Bank for International Settlements handed mBridge over to the participating central banks. It's now fully operational for select corporate customers. Hundreds of transactions valued at billions of dollars have already been processed. Western officials fear that the technology for a competing global payment system is now in the hands of nations that are, at minimum, economic rivals, and at worst, geopolitical adversaries. Economic rivals, and at worst, geopolitical adversaries. Commodity exchanges are also playing a role. The Shanghai International Energy Exchange now allows oil futures to be traded in yuan. Dubai and other Middle Eastern hubs are exploring non-dollar denominated energy contracts. These aren't just technological experiments. They're the infrastructure of a new financial order. Geopolitical rebalancing and risks. This shift is fundamentally reordering global financial power. And it's creating winners and losers. China is the single biggest beneficiary. The digital yuan has been integrated into critical infrastructure across Africa, Central Asia, the Middle East, and Latin America through the Belt and Road Initiative. Beijing doesn't need to replace the dollar outright. It just needs to make it optional. And in many trade corridors, it already has. BRICS plus nations, which now include Saudi Arabia and the UAE, collectively control 42% of global central bank foreign exchange reserves. Their combined GDP represents over 40% of the world's population and more than 25% of the global economy. This is not a fringe movement. This is a fundamental rebalancing. Russia and Iran, both heavily sanctioned, are driving this shift out of necessity. But they're not alone. Even close U.S. allies are hedging. France's yuan-denominated LNG deal with China was a signal. Saudi Arabia's willingness to accept multiple currencies for oil is another. For the United States, the risks are profound. Reduced demand for dollars means reduced demand for U.S. Treasury bonds. This could lead to higher borrowing costs for the U.S. government. A weaker dollar makes imports more expensive, contributing to inflation. And the unique privilege of financing deficits at low interest rates, the so-called exorbitant privilege, begins to erode. For traditional economies deeply integrated into the dollar system, this creates inflationary pressures and currency volatility. Countries that hold large dollar reserves could see the value of those reserves decline. Exchange rate fluctuations become more unpredictable in a multipolar currency landscape. And there's a darker risk, financial fragmentation. The world could fracture into competing economic blocs. A Western bloc centered on the dollar and euro. A BRICS bloc centered on the yuan, rupee, and alternative payment systems. Reduced interoperability between these systems could increase transaction costs, slow trade, and create opportunities for conflict. President Trump has explicitly warned that any attempt by BRICS to bypass the dollar would lead to 100% tariffs on exports to the United States. This threat of economic retaliation has had mixed results. Some nations have slowed their de-dollarization efforts. Others have accelerated them, viewing the threat as validation that alternatives are necessary. The weaponization of finance has triggered a defensive reaction, and that reaction is now taking concrete form. The future of energy, payments. So what does the world look like in 2030? The most likely scenario is a truly multipolar currency landscape. The dollar will remain dominant, but not overwhelmingly so. It will coexist with the yuan, the euro, and increasingly, digital currencies and gold. Oil and energy transactions, once exclusively priced in dollars, will be settled in a basket of currencies depending on the buyer and seller. A Chinese company buying Saudi oil might pay in yuan. An Indian refiner purchasing Russian gas might use rupees. A European nation might still use dollars or euros. By 2030, experts estimate that non-dollar energy transactions could account for 30 to 40% of global oil trade. The petrodollar won't disappear, but it will be one option among many. Central bank digital currencies will play a major role. The digital yuan, digital rupee, and potentially a BRICS-backed digital settlement instrument could handle a significant portion of cross-border energy payments. These systems will be faster, cheaper, and less dependent on Western financial infrastructure. BRICS Pay, or something like it, could be operational in processing trillions of dollars in trade annually. The new development bank, the BRICS financial institution, will expand lending in local currencies, reducing reliance on dollar-denominated debt. For resilient economies and innovative financial players, this creates opportunities. Countries that develop robust digital payment infrastructure will attract trade and investment. Financial institutions that can operate across multiple currency systems will thrive. Businesses that adapt to currency diversification will have competitive advantages. For investors, this means rethinking traditional assumptions. A diversified portfolio might include exposure to yuan-denominated assets, gold, and digital currencies. The stability of the global economy will depend less on a single reserve currency and more on the resilience of interconnected systems. But there are risks. A fragmented financial system is less efficient. Transaction costs could rise. Currency volatility could increase, and the potential for economic conflicts between blocs is real. If history offers any lessons, it's that no currency remains dominant forever. The British pound once held the position the dollar holds today. In 1948, the pound accounted for twice the global reserve share of the dollar. By 1969, the dollar had overtaken it tenfold. By 1980, the pound had declined to just 2% of global reserves. Currency power follows economic power, and economic power is shifting. Imagine a world where oil isn't paid for in dollars. It sounds impossible, right? Yet, that's precisely the future rapidly taking shape. Is the reign of the petrodollar finally over? Don't let the headlines fool you. The true story of global energy payments is far more complex and urgent than most people realize. Western sanctions have fundamentally rewritten the rules. New power players are emerging. China's digital yuan, BRICS payment systems, bilateral currency agreements, central bank digital currencies. Each one is a brick in a new financial architecture. And the vulnerabilities are surprising. The United States, once unassailable in its financial dominance, now faces higher borrowing costs, inflation risks, and the potential loss of its exorbitant privilege. Traditional economies must navigate currency volatility and fragmentation. But there are also unprecedented opportunities for nations that build resilient, interoperable systems, for businesses that adapt to a multipolar currency world, for investors who diversify beyond dollar-centric assets. The petrodollar system isn't dead, but it's no longer exclusive, it's no longer inevitable, and its decline is accelerating. What happens next will reshape global trade, redefine economic power, and determine the financial stability of nations for generations. The future of money is being written right now. And whether you're an investor, a business leader, or simply someone trying to understand the world, this is a story you cannot afford to ignore. The era of dollar dominance is not over, but the era of dollar inevitability is ending, and the race to build the financial system of the future has already begun.